It was another quiet day on Wall Street with all four U.S. equity indices trading in a daily range within their average true range. In fact, today was so flat, we had an end result or a change on the S&P 500 of 0.00%. You don't see that a whole lot. We did see a little bit further downside pressure on the Russell 2000 small cap index. In fact, that was the third straight day of underperformance, but we're now set up with what's known as a bullish intermediate confirmation signal on that particular index. So perhaps an opportunity to see a little bit of upside action in coming days. Tomorrow is options expiration, and so we might see a little bit more volatility there. And then tomorrow also represents the 1-year anniversary of last year's market top, and so it's a possibility that we'll start seeing a few more new highs hit here in the next couple of weeks or so. We do want to focus on our trade application day within a strategy that takes advantage of some of these quieter markets with an iron condor, and I want to do that within the healthcare space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 19th, 2019. First of all, if you're new, welcome. Remember, you can sign up for our email distribution list by going to the description area over on YouTube. And while you're over there, you might as well subscribe to our channel as well. In addition to that, we're heavy users of Twitter. Make sure you're following me at Brandon Van Zee. And we do appreciate those of you that click like and retweet on these Market Outlook related posts. Lastly, we have a focus there in Facebook as well. We have a group that you can join at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I'm looking at chart 4B here. And as a reminder, I will be sending out an email to those of you that are premium members of Market Scholars tomorrow with all of our brand new charts. There will be about 46 or 47 charts that you'll have access to. Also, there were 2 people that signed up here today in our premium services. And if you're listening right now, I would encourage you not to download our old charts, because I'd hate to have you go through that whole process and then one day later having to redo all of them. So anyway, make sure that you hold off for just one more day there. But anyway, these are our charts here that will show us the market forecast on the 4 different major equity indices out there. And I wanted to spend some time showing you here at the Russell 2000, which is our chart in the lower right-hand corner. This is the one that I referenced in the intro that had been underperforming for the last 3 days. You'll notice we have 3 sell-off days in a row right there with the Russell 2000. And that has created a situation where we now have a bullish intermediate confirmation signal. So let me right-click on the chart and go to maximize sell here. And as you can see down below, we have the green line that's in the upper reversal zone, and that designates a strong bullish posture from an intermediate perspective, combined with the red line in the lower reversal zone on the same day, and that's our momentum line. And so that gives us a sensation that we have a strong trend from an intermediate perspective matched with a short-term pullback in price from a momentum perspective. So that's kind of known as a buy the dips mentality. You can see that that dip that I'm referring to has occurred over the last 3 or 4 days right there. Now, we've found historically that the strategy works a little bit better, or the signal works a little bit better, when we have the blue line, which is the near-term line here, somewhere between 20 and 50. And as you can see, that is where we stand right now. So while the blue line's not technically part of the bullish intermediate confirmation signal, you can use it as kind of an enhancement to that signal to see if you have a slightly better setup. So right now, I guess you would consider this a slightly better setup. Unfortunately, it does kind of fly in the face of what some of you may perceive to be as a little bit of a double top that's taking place up here from where we topped out in July to where we topped out here about 4 days ago. So we'll have to see, if we can emerge above that area and break through that resistance. In fact, that happens to be kind of an issue with all 4 of our charts. Let me go back to the 4-grid view here. And you can kind of see that the most recent high that we had in all of our charts was back here in July. And so it would be a shame to come this far and have this nice of a rally here ever since the end of August and then fall a little bit short of hitting new highs. So right now, there's no reason to believe that we can't do it. However, you will notice, as I mentioned in the intro, the S&P 500 closed exactly flat today. It was technically up 6 cents, but that didn't even amount to 0.1%. It was 0.00% close there on the S&P 500. However, when you look at this candle, it would have have a slightly bearish tilt because it's basically saying that price was higher throughout the session, and then by the time the closing bell rang, the sellers kind of took control and pushed the market right back down to where it opened. And so that is the case with kind of all of our charts here today. You can see those kind of big upper shadows there on the tops of those bodies. So we'll have to see where it takes us. What we do know is that as it stands right now, we continue to have bullish intermediate postures on all four of our charts. That background color of the chart will help us signify that, especially that dark green background color right there. Not only that, but we also have moving averages that are all painted green at this point as well, and that reminds us that price is above a rising moving average. So although we do have a little bit of concern with overhead resistance on all four of our charts, we're within a stone's throw of achieving that breakthrough, and all it takes is a good news story here or there to get us up and through there. And right now the path of least resistance is to the upside, so I have no reason to believe that we can't achieve that here with most of these market indices. Let's go ahead and take a look at another chart setup here. Let's go ahead and take a peek here at, let's do chart 4D, the three green arrows chart right here. Again, these charts might have a slightly different order than yours. Those of you that are premium members of Market Scholars right now, I'll be sending you all an email tomorrow with the new order of these charts. That also includes several brand new charts that you guys don't have access to. So if you get confused here tonight, that's the reason behind it. I'm kind of using the new grid setup here on Thursday night, and those of you that are premium members won't receive those links until Friday, okay? And so anyway, as we look at the three green arrows chart setup here now, you can see that all four of our charts do have three green arrows, and so that's another promising sign of this market. One of the challenges of that is that unfortunately the three green arrow signal has been going on for quite some time now, and so it's possible it's running its course a little bit here in the short term. So for example, notice over here on the Dow Jones, we've fallen on that MACD histogram to the point where we're getting very close to that zero line on there. And remember, once we go below that zero line, we will produce a red arrow, similar to how we did that back here. Now notice the trend was not destroyed as a result of that red arrow, so it's not some sort of a major warning sign that you got to rush for the exits or anything like that. It's just basically signifying the fact that we've had a little bit of a loss of momentum compared to when we first received that green arrow up there and started moving higher. That was at a point where those candles were advancing at an ever greater rate, whereas more recently in the last week or so we've kind of just treaded sideways on most of these indices. So as it stands right now, we do have three green arrows on all of these, but don't be surprised at all if we lose that three green arrow status here in the next few sessions, unless we're able to get a nice shot in the arm and get up and through that resistance point back there in July that I mentioned before. Even if that's the case, still obviously follow your rules. Three green arrows isn't necessarily a buy, and three red arrows isn't necessarily a sell. Obviously, you're trying to do your best to use as many tools and indications that you have available to you to make the next best decision for your various trades. And of course, that's the type of thing that David and I try to help our clients out with here at Market Scholars. In fact, we had a great question and answer session here earlier today. It's about 2.5 hours long, and so we had some excellent content that is now posted for those of you that want to check in on the types of things that we discussed there. And then David taught his portfolio management class here earlier today as well. Tomorrow, David will be teaching his technical analysis class, which is one of our most popular classes out there. And so make sure you're checking that out if you have the opportunity as well. Let's go ahead and take a look at another chart here. In this case, let's go ahead and talk about our longer term view, the 1040 crossover method. This is chart 4C on the new chart setup. And the story that we've been discussing here more recently is what's been going on with the Russell 2000. Now, things looked a little bit better earlier in the week, but after 3 straight sell-off days for the Russell 2000, it doesn't look like we're going to quite get to the crossover here this week. Now, it's not saying that's impossible. If we have a big rally tomorrow that includes the small cap index, that is a possibility. But as it stands right now, we do continue to have a bearish crossover using the 10 and 40 weekly moving averages. So if I right click and go to maximize sell here, You can see how close we are to having a bullish crossover. We're looking for that orange line to get up and through that blue line right there, and you can see down below we're very close with that purple line getting through that black line. So those will kind of coincide at the exact same time right there. But as I was kind of mentioning in the video on Tuesday, even if we do get a bullish crossover or a golden cross, some of you might refer to it as, you got to be a little bit hesitant, just knowing that the last couple of times we've gotten those bullish crossovers, they've been head fakes. In other words, when the chart went from pink to green here and the chart went from pink to green here, those were actually better times to be selling the Russell 2000 than to be buying it, just given the choppy nature of the trend here more recently. Usually the 1040 crossover method works better when we're on the cusp of a big steady trend, either up or down. In this particular case back here, you can see we were on pace for a nice healthy trend higher, and it worked very nicely to be following that strategy. Whereas more recently, it has been chop and slop and really hasn't done you many favors. The other charts are all still in great shape. Those ones have not been choppy sideways the same way that Russell 2000 has, and so those ones have continued to keep you on the right side of the market, in other words, the bullish side of the market, ever since the beginning of this year. All right, let's go ahead and now do a little bit of 12 grid analysis. And so let's go ahead and get started here on, how about the asset classes 12 grid. So this will be our new chart 5A, again starting tomorrow when you guys get those new links. So as I was mentioning to you guys on Tuesday, this new chart setup here, there's kind of a slight twist to the way that it used to be when you used to see me do the analysis on these 12 grids. And that slight twist is that there's another color scheme that's kind of embedded within here, and that was at a request of a few of you along the way. So for example, let's use preferred stocks in the upper right versus foreign stocks right next to it. Notice that preferred stocks has a lighter green shade of the background color, whereas foreign stocks has that darker green shade right there. What distinguishes those two is whether we would consider it to have a strongly bullish posture or a weakly bullish posture. Remember, when the green intermediate line on the market forecast is rising somewhere between 20 and 50, we would simply deem that to be a weakly bullish posture. If the intermediate line instead is between 50 and 80 and it's rising, we would consider that to be a strongly bullish posture. And remember, anytime you're in the upper reversal zone, which is above 80, we also consider that to be a strongly bullish posture. So note here, for example, with foreign stocks, the green line is actually falling. The green intermediate line on the market forecast is actually falling, but because the reading is above 80, it's in the upper reversal zone and retains its strongly bullish posture there. So that would be distinguished from, let's say, oil down below here, where it also has that dark green shade background color to signify a strongly bullish posture. But in this case, notice that the reading is below 80. At this point, it's between 20 and 8, or I'm sorry, between 50 and 80, and it's rising, and that's why it does have that strongly bullish posture there. The US dollar actually had an exactly flat intermediate line, and that's why the background color there is white. So anyway, it'll take a little bit of time for you guys to kind of get used to that, but hopefully that's a slight enhancement that will benefit your eyes to kind of know where the stronger trends are of the particular charts, at least according to the market forecast technical indicator. You know, as I look at these various charts here in front of us, I would say that real estate remains the one that's kind of capturing my attention right now. This is the one that appears to have one of the steadier charts on the board, where we have consistent higher highs and higher lows. You know, we did have an era here a few weeks back where a lot of the bond-related charts were showing a lot more consistency, but that has kind of changed shape here in the last 2 or 3 weeks. You'll notice here foreign bonds all of a sudden have a strongly bearish posture, and we're now trading below a falling moving average as of today. Note that that moving average right there just turned red. And you could say a lot of the same things about long-term U.S. Treasuries, although right now that moving average is kind of going between uptrending and downtrending right there. But nonetheless, the point is the bond market isn't quite as consistent of a trend as it was for much of the summer. However, real estate and REITs in particular have continued to do reasonably well. Let's take a look at another set of 12 grids here. In this case, let's go to the U.S. sectors 12 grid. This will be our new chart 5C. And here you can see things look pretty strong. In fact, we have 11 out of the 12 charts on the board here green, not only green, but dark green, to signify that we have a strongly bullish posture in 11 out of these 12 charts. The only exception to that is the consumer staples. And as you look at the consumer staples chart, it doesn't even look that bad. It's just that the green intermediate line fell out of the upper reversal zone here earlier this week, and so it's just kind of trying to sort itself out. But as you look at the price action, price remains above a rising moving average. So it's just kind of burning off some of that fat a little bit after having put in an overbought cluster signal here back on September 4th. But the give back in staples, in my opinion, has not been overly egregious. And at this point, I would probably be a little bit more interested in looking for bounce opportunities higher out of the staples. In fact, there was one stock today I got awfully close to bringing up as a trade idea, which was Coca-Cola. You can see Coca-Cola has been riding that upward trending moving average right there. Had a nice looking day today where we are up about 0.5%, bouncing up and off of that moving average is usually a healthy sign there. So we'll see if that happens in the end or not. But what we can say is that for the most part, according to the market forecast technical indicator, we do have some fairly strong postures out there. In terms of the best looking trends just from the old eyeball test, I would say that probably belongs to the utilities. Utilities have been resilient. Even when we had that quick swoon there 2 weeks ago, where a lot of money came out of the low volatility and momentum factors and went into the value factors. Remember, right now, utility stocks are not value stocks. They are momentum stocks. And so they got kind of caught up in that. But despite that kind of rotation that took place. Remember when I showed you on Tuesday that utilities actually maintained their second place ranking on the sector selector, and at the time I thought it was maybe a little bit goofy, but now I'm seeing that yes, they deserve to hold the level. For the last 4 days, utilities have gone straight back up. We actually own 5 different utility companies in our 25 stock portfolio for my Monday top-down trend trading class, and all of them are hitting new highs. And so we're happy about that in that particular class. We'll just have to see where it takes us. But right now, it does appear that utilities continue to be one of the workhorses of this market. And I mentioned real estate before. That comes in kind of in second place in my eyes in terms of the way that the trend looks right now of these various charts. All right, let's take a look at another chart setup here. Let's go on over here to the global stocks primary 12 grid. This is going to be our new chart 5E. And here you can see it's a little bit more of a mixed bag. We do have 2 pink charts on the board. That's India kind of there in the middle, and we have Brazil there in the lower left-hand corner. Those two have what we would deem to be weakly bearish postures, not strongly bearish, but weakly bearish. So they've done a little bit of work here recently to kind of stabilize themselves, and they're trying their best to turn that moving average around. Note that on India, that moving average was going straight lower there for a while, but with the holding of the line from a stock price perspective here, now you're starting to see that moving average starting to flatten there a touch as well. Same thing is going on kind of down below here with Brazil. In terms of the better looking charts from the eyeball test, I would say that Japan probably captures my interest right here. Japan didn't have the best looking candle here today. However, we were able to achieve a new multi-month high on Japan today. In fact, we're up about 5% over the last 3 months. And you can see the intermediate line is up there at around the 95th percentile. Canada also looks fairly strong. We got just barely up and over that prior high on the Canadian exchange back on, it looks like it was July 10th. And so that one also looks reasonably strong. Maybe not quite as strong as Japan, but nonetheless, it's been doing some work here lately. Let's take a look at our secondary global stocks now. And this one will be the new chart 5G. All right, so on this one, we've got a little bit more weakness. You can see that we have 5 pink charts on the board, and this one will give us an opportunity to show you an example of a strongly bearish posture versus a weakly bearish posture. So note here as an example, Turkey here kind of in the middle has that lighter pink shading of the background. The reason for that is the moving average intermediate line has fallen out of the upper reversal zone, so it's now below 80, but it's not down below 50 yet. So because it's below 80 and falling, it does have that bearish posture, but we would consider it a weakly bearish posture. Whereas down below here on Argentina, you can see that its current reading is at 8.92. Remember, anything below 20 is considered in the lower reversal zone and is considered a strongly bearish posture, so it has that darker shade of pink that it's dealing with right there. Same thing can be said for Saudi Arabia. However, Saudi Arabia had a nice little pop out of that range here today. Both of those indices were actually up over 1%. The Saudi Arabia one looks a little bit more interesting because you can see how it's popping higher and is now at its highest level over the last week or so. Whereas despite the big move out in Argentina, this is such a volatile index that it's really just in line with where we've been trading for the last week or so. So both of them have a lot more work to do before we get excited about them, but at least they started with a nice little shot higher here by over 1% today. You'll notice that a lot of these oversold cluster signals are stacking up upon one another, so perhaps it's time for a bit of a dead cat bounce out of those. However, you'd only want to apply your more speculative money to that because you would still consider these counter trend types of trade situations as it stands right now. In terms of the better looking charts on the board, I would have to give that to Taiwan at this particular time. Taiwan didn't quite hit a new 3-month high today, but it was only a week ago that it did so, and we're within spitting distance of doing that. So it could happen as soon as tomorrow under the right set of circumstances. So Taiwan is up there in that 95th percentile on the market forecast intermediate line, a very strong showing. All right, so let's go ahead and now kind of talk about our trade application example. I'm going to come on over here to, let me just go to 4A and see what that does here for me. If not, we'll go over to the swing trading view. But I wanted to pull up a very well-known healthcare company, and that's Merck. Merck, as you can see, has been stuck in a sideways range for the entire 3 months that this chart shows. Now, to give you a sense of what's been happening with healthcare over that time period, it looks fairly similar. Healthcare happens to be right in the middle of its range over the last 3 months as well. The chart shape looks a little bit different, but what draws those two together, both Merck and in this case XLV, which tracks the healthcare sector, is that right now they're basically smack dab in the middle of the high and the low of the category. In fact, you can see the high was up here around 94, the low was down here at around 88, and you find yourselves right here at about 91, right in kind of the middle of that range right there. And so Merck is somewhat similar. Its high was 87, its low was 78, and we find ourselves right now around 83 or 84, right in the middle of that range. So it seems like we have a pattern on our hands here where healthcare stocks haven't done terribly. Then again, they haven't lit the world on fire to the upside either. We have seen a strong rally in the general stock market in recent weeks, yet healthcare hasn't really participated in that, and as you can see, either has Merck. They've really just kind of held the line. On the other hand, when the stock market was falling a little bit more violently back in August, you can see Merck actually went up during that time period. So it almost is kind of acting opposite of the market right now, but not making extreme moves in one direction or another. So when you see charts that look like this, one way to try to take advantage of that, if you assume that this pattern that we've seen for the last 3 months holds for, let's say, another month or so, is by conducting what's known as an iron condor trade. Now, most of you are aware that an iron condor is simply a structuring of two different credit spreads. One of them would be a bull put spread. One of them would be a bear call spread. So both of those are credit spreads to start things off. So it makes the iron condor somewhat interesting in that you kind of receive two credits, one from the upper side of the target, one from the lower side of the target. And what you're hoping to accomplish is to have that stock in question continue to go reasonably sideways without a violent move up or a violent move down. And if that can occur, then you get the benefit of keeping both of those credits, one from the bull put spread side of the equation and one from the bear call spread side of the equation. So let's see what we have available to us here in the chart of Merck. Coming on over here to the trade tab, I've already got the choices that I wanted to make here pulled up just to save us a little bit of time. But you can see down below here that we do have the October 25th weekly contracts that we're dealing with here. So note that the October monthly contracts expire in 29 days. The one that I'm dealing with for this particular trade is the one that expires in 36 days. So it'd be the following weekly contracts after the monthly expirations here. Now the reason I did that is because I looked at the exact same strikes on the monthly, and we ended up being just short of a 30% return on risk, which is generally our minimum hurdle rate on these types of trades. And so I just opted to go one more week out. Now, in doing so, I wanted to double check one thing, which was I wanted to see when was earnings going to be announced. So what I did is I looked at their last earnings announcement, and you can see here it was on July 30th. So if we add 3 months to that, their earnings should come out next at around October 30th. And so what the point of me bringing that up is we should be out of our trade by the time they report their next earnings, because these contracts will expire on October 25th, so about a week before they report their earnings. So as long as this can stay kind of sideways between now and then for the next 30 or so days, then we should be in fairly good shape on this particular trade. Now, the way that I set this up was I looked for the 20 deltas. So, note here, if I were to pull up the October 25th and look at the delta column over here, note that we have a 19 delta and we have a 22 delta. And so I ended up going with this 22 delta in this case, with the thinking that the 80 contracts would be just a little bit more liquid there. And so you can see that is the contract I've selected as our sold strike down below here on the put side of the equation. And then I've selected the 77.50 as our bought put, so a $2.50 wide on that bull put spread. And then I had an equal distance spread on the call side. Again, you can see down below here, I've got $2.50 between these strikes. In this case, my sold strike is at 87.50. So if I were to look at that, you can see that's also a delta of 22 in this particular case. And then our bought strike is the 90. Now, the reason that we have a bought 90 call and a bought 77.50 put, for those of you that are unfamiliar with this, is just in case we're blatantly wrong. If we think this is going to be a steady Eddie sideways chart and it ends up going dramatically higher or dramatically lower, those bought strikes are part of our insurance. They're part of our protection that is embedded within the trade, so that way we can't get run over too badly as long as we're position sizing the right way. Now, you'll note in this particular trade we get a credit of about 67 cents. If I were to click confirm and send here, just to get the numbers, note that if I took the $67 that we'll take in as credit here and divide that by the max loss of 183, that's where we get our 36.6% return on risk. So again, you have the ability to trade these exact same strikes on the October monthly contracts, but when I ran the math there before doing the presentation, the end result was just an ROR that was slightly below 30%. So that's why I'm opting for these weeklies instead. But since we're over here, I'm also going to notate our break-even prices on this trade. 79.33 is our break-even price on the downside, and 88.17 is our break-even price on the upside. Maybe we could take a second here to go to the chart and kind of draw those lines. So I'm going to go to my drawing tools, and I'm going to come over here to our price level. And then I'm going to draw a line up here on the top, and I'm going to draw another line down here on the bottom, and I'm going to adjust them accordingly by right-clicking on the top line, going to Edit Properties, and I'm going to change this number to 88.17 and hit OK. And then on this bottom line, I'm going to right-click on that, Edit Properties, and change this to 79.33 and hit OK. So what we're looking at right here with the upper dashed line and the lower dashed line is our range that we can allow this chart to stay in for the next 30 days. And again, you can see nearly 98% of the time of Merck's trading in the last 3 months was between those two lines. And so if that continues to be the case for the next 1 month, we should be able to make some money on this trade. So I'll go ahead and fire that off, and we'll see if we can get filled on that first thing in the morning. All right, thank you for joining me here tonight. Remember, we had a quiet day in the markets, but tomorrow we might see a little bit of an uptick in volatility with options expiration. On the whole, we do have bullish postures across the board, but obviously we want to keep our eye on the situation as there's always news that can affect our posture. So David will be back with you tomorrow to discuss that from his perspective. I'll be doing my sector selector tomorrow night. And remember, for those of you that are premium yearly members of Market Scholars, I'll be sending you out an email this weekend with all those new chart scripts. So look forward to that as well. All right, have yourself a great rest of the night. Take care, everybody. Bye-bye.